Ever wondered how to grow your savings faster than a piggy bank? Let's explore stock investing. Stock investing can seem intimidating at first, but with the right knowledge and approach, it can be a powerful tool to grow your wealth over time. In this guide, we'll break down the basics and help you get started on your investing journey. So why should you consider investing in stocks? Well, unlike a traditional savings account where your money grows at a fixed interest rate, investing in stocks offers the potential for much higher returns. Of course, with higher potential returns comes higher risk, but with careful planning and research, you can manage these risks effectively. Investing in stocks means buying small parts of a company. When you purchase a stock, you become a shareholder, which means you own a piece of that company. This ownership entitles you to a portion of the company's profits, which are typically paid out in the form of dividends. Additionally, if the company performs well and its stock price increases, the value of your investment grows. It's important to understand that stock prices can fluctuate based on a variety of factors, including the company's performance, market conditions, and investor sentiment. Think of it like owning a slice of your favorite pizza. Just as each slice represents a portion of the whole pizza, each share of stock represents a portion of the company. The more shares you own, the larger your slice of the company's profits and potential growth. However, just like a pizza can be affected by various factors such as the quality of ingredients or the skill of the chef, a company's stock can be influenced by its management, industry trends, and economic conditions. When the company does well, your slice gets bigger and more valuable. This means that as the company grows and becomes more profitable, the value of your shares increases. Conversely, if the company faces challenges or performs poorly, the value of your shares may decrease. It's important to stay informed about the companies you invest in and to diversify your investments to spread risk. First, you'll need a brokerage account. A brokerage account is an investment account that allows you to buy and sell stocks, bonds, mutual funds, and other securities. There are many online brokerage platforms available, each with its own set of features, fees, and tools. When choosing a brokerage, consider factors such as account minimums, commission fees, and the availability of research and educational resources. It's like a bank account, but for buying and selling stocks. Once you've opened a brokerage account, you can deposit funds and start purchasing stocks. Most online brokerages offer user-friendly platforms that make it easy to place trades, track your investments, and access market data. It's important to familiarize yourself with the platform and take advantage of any educational resources offered by the brokerage. Many online platforms make this super easy. Next, research. Research is a crucial part of successful investing. Before buying a stock, it's important to thoroughly research the company and understand its business model, financial health, and growth prospects. There are many resources available to help you with this, including financial news websites, stock analysis tools, and company financial statements. Look into companies you believe in. Investing in companies that align with your values and interests can make the research process more enjoyable and help you stay engaged with your investments. Consider factors such as the company's competitive advantage, management team, and industry trends. It's also important to look at the company's financial statements, including its income statement, balance sheet, and cash flow statement, to assess its financial health. Do they have a good track record? A company's past performance can provide valuable insights into its future potential. Look at metrics such as revenue growth, profit margins, and return on equity to gauge the company's financial performance. Additionally, consider the company's track record of innovation, customer satisfaction, and market share. While past performance is not a guarantee of future results, it can help you make more informed investment decisions. Are they likely to grow? Assessing a company's growth potential involves looking at factors such as its market opportunity, competitive position, and strategic initiatives. Consider whether the company operates in a growing industry and whether it has a clear plan for expanding its market share. Additionally, look at the company's investment in research and development, its ability to adapt to changing market conditions, and its track record of successful product launches. This helps you make informed choices. Start small. When you're just starting out, it's a good idea to begin with a small investment. This allows you to learn the ropes and gain experience without risking a large amount of money. As you become more comfortable with the process and gain confidence in your investment decisions, you can gradually increase your investment amount. You don't need a lot of money to begin. One of the great things about stock investing is that you can start with a relatively small amount of money. Many online brokerages offer fractional shares, which allow you to buy a portion of a share of stock. This means you can invest in high-priced stocks without needing to come up with the full share price. Additionally, some brokerages offer commission-free trading, which can help you keep costs low. Even $50 can get you started. With fractional shares and commission-free trading, you can start building your investment portfolio with as little as $50. The key is to start early and invest regularly. Over time, even small investments can grow significantly through the power of compounding. Compounding is the process by which your investment earnings generate additional earnings, leading to exponential growth over time. Remember, the stock market goes up and down. It's normal. Patience is key. The stock market is inherently volatile, and prices can fluctuate based on a variety of factors. It's important to stay focused on your long-term goals and not be swayed by short-term market movements. Having a well-thought-out investment strategy and sticking to it can help you navigate market volatility and stay on track to achieve your financial goals. And there you have it. With a bit of time and research, you'll be on your way to becoming a savvy investor. Happy investing! Remember, investing is a journey, and it's important to continue learning and adapting as you go. Stay informed about market trends, keep an eye on your investments, and don't be afraid to seek advice from financial professionals if needed. With dedication and persistence, you can build a successful investment portfolio and achieve your financial goals. With a bit of time and research, you'll be on your way to becoming a savvy investor. Happy investing! Remember, investing is a journey, and it's important to continue learning and adapting as you go. Stay informed about market trends, keep an eye on your investments, and don't be afraid to seek advice from financial professionals if needed. With dedication and persistence, you can build a successful investment portfolio and achieve your financial goals. One of the most powerful concepts in investing is compounding. Compounding is the process by which your investment earnings generate additional earnings, leading to exponential growth over time. By reinvesting your dividends and allowing your investments to grow, you can take advantage of the power of compounding to build wealth over the long term. Diversification is another key principle of successful investing. Diversification involves spreading your investments across different asset classes, industries, and geographic regions to reduce risk. By diversifying your portfolio, you can protect yourself against the impact of poor performance in any single investment and increase your chances of achieving consistent returns. Another effective strategy is dollar-cost averaging. Dollar-cost averaging involves investing a fixed amount of money at regular intervals, regardless of market conditions. This approach can help you avoid the pitfalls of trying to time the market and reduce the impact of market volatility on your investments. By consistently investing over time, you can take advantage of market dips and build a strong investment portfolio. Rebalancing your portfolio is also important. Rebalancing involves periodically adjusting your investment holdings to maintain your desired asset allocation. This can help you stay on track with your investment strategy and ensure that your portfolio remains aligned with your financial goals. Regularly reviewing and rebalancing your portfolio can help you manage risk and take advantage of new investment opportunities. Setting clear financial goals is essential for successful investing. Whether you're saving for retirement, a down payment on a house, or your child's education, having specific goals can help you stay focused and motivated. Consider your time horizon, risk tolerance, and financial needs when setting your investment goals. Having a clear plan can help you make informed decisions and stay on track to achieve your objectives. Don't hesitate to seek professional advice if needed. A financial advisor can provide valuable guidance and help you develop a personalized investment strategy. They can also help you navigate complex financial situations and make informed decisions. Whether you're just starting out or looking to optimize your existing portfolio, a financial advisor can be a valuable resource. Staying informed about market trends and continuously learning is crucial for successful investing. The financial markets are constantly evolving, and staying up to date with the latest news and developments can help you make better investment decisions. Take advantage of educational resources, attend webinars, and read books and articles on investing to expand your knowledge and stay ahead of the curve. Celebrate your investment milestones and achievements. Reaching your financial goals is a significant accomplishment, and it's important to acknowledge and celebrate your progress. Whether it's reaching a savings target, achieving a certain return on investment, or simply sticking to your investment plan, take the time to recognize your successes and stay motivated for the future. Remember, investing is a long-term endeavor. Building wealth through investing takes time, patience, and discipline. Stay focused on your long-term goals, remain committed to your investment strategy, and don't be discouraged by short-term market fluctuations. With a consistent and thoughtful approach, you can achieve financial success and build a secure future for yourself and your loved ones. Regularly review your investment portfolio and make informed decisions. Periodically assessing your investments can help you stay on track with your financial goals and make necessary adjustments. Consider factors such as changes in your financial situation, market conditions, and your investment objectives when reviewing your portfolio. Staying proactive and engaged with your investments can help you achieve better outcomes. Understanding your risk tolerance is key to successful investing. Your risk tolerance is your ability and willingness to endure market volatility and potential losses. It's important to align your investments with your risk profile to ensure that you can stay comfortable and confident with your investment decisions. Consider factors such as your age, financial situation, and investment goals when assessing your risk tolerance. Building a diversified investment portfolio is essential for managing risk and achieving consistent returns. Diversification involves spreading your investments across different asset classes, industries, and geographic regions. By diversifying your portfolio, you can reduce the impact of poor performance in any single investment and increase your chances of achieving your financial goals. Consider investing in index funds as a low-cost and effective way to diversify your portfolio. Index funds are mutual funds or exchange-traded funds, ETFs, that aim to replicate the performance of a specific market index, such as the S&P 500. They offer broad market exposure, low fees, and the potential for consistent returns. Index funds can be a great option for beginner investors looking to build a diversified portfolio. Monitor your investment performance and track your progress. Regularly reviewing your investments can help you stay on top of your financial goals and make necessary adjustments. Use tools and resources provided by your brokerage to track your portfolio's performance, analyze your returns, and identify areas for improvement. Staying engaged with your investments can help you achieve better outcomes and stay motivated. Stay disciplined with your investment strategy and avoid making emotional decisions. Market volatility can trigger emotional reactions, but it's important to stay focused on your long-term goals and stick to your investment plan. Avoid making impulsive decisions based on short-term market movements, and instead, rely on your research and strategy to guide your investment choices. Reinvesting dividends is a powerful way to maximize your investment growth. Dividends are payments made by companies to their shareholders, typically from their profits. By reinvesting these dividends back into your investments, you can take advantage of the power of compounding and accelerate your wealth-building process. Many brokerages offer automatic dividend reinvestment plans, making it easy to reinvest your earnings. Understanding market cycles and navigating economic changes is crucial for successful investing. The stock market goes through periods of growth and decline known as market cycles. By understanding these cycles and staying informed about economic trends, you can make more informed investment decisions and better manage your portfolio. Stay patient and focused on your long-term goals, and be prepared to adapt to changing market conditions. Investing in growth stocks can offer significant potential for returns. Growth stocks are shares of companies that are expected to grow at an above-average rate compared to other companies. These companies often reinvest their earnings into expanding their business, developing new products, and entering new markets. While growth stocks can be more volatile, they offer the potential for substantial capital appreciation over time. Balancing growth and value investments can help you create a well-rounded portfolio. Value stocks are shares of companies that are considered undervalued based on their fundamentals, such as earnings, dividends, and book value. These stocks may offer more stability and income potential compared to growth stocks. By including both growth and value investments in your portfolio, you can achieve a balance of risk and return. Investing in dividend-paying stocks can provide a steady stream of passive income. Dividend stocks are shares of companies that regularly distribute a portion of their profits to shareholders in the form of dividends. These stocks can offer a reliable source of income, especially for investors looking to supplement their earnings or build a retirement income stream. Look for companies with a strong track record of dividend payments and the potential for dividend growth. Understanding the impact of inflation on your investments is important for protecting your purchasing power. Inflation is the rate at which the general level of prices for goods and services rises, eroding the value of money over time. By investing in assets that have the potential to outpace inflation, such as stocks, you can help preserve and grow your wealth. Consider including inflation-protected securities, such as Treasury inflation-protected securities, TIPS, in your portfolio to hedge against inflation. Setting up automatic investments can help you stay consistent with your contribution strategy. Many brokerages offer automatic investment plans that allow you to regularly invest a fixed amount of money into your chosen investments. This approach can help you stay disciplined, take advantage of dollar-cost averaging, and ensure that you're consistently working towards your financial goals. Regularly reviewing and adjusting your investment strategy is important for staying flexible and responsive to changing market conditions. As your financial situation, goals, and risk tolerance evolve, it's important to reassess your investment strategy and make necessary adjustments. Stay proactive and open to new opportunities, and be prepared to adapt your approach as needed to achieve your financial objectives. Building a strong financial foundation is key to achieving long-term success. This involves not only investing wisely, but also managing your overall financial health. Create a budget, save for emergencies, pay down debt, and plan for major expenses. By taking a holistic approach to your finances, you can create a solid foundation that supports your investment goals and helps you achieve financial security. Celebrate your financial milestones and stay motivated on your investing journey. Reaching your financial goals is a significant accomplishment, and it's important to acknowledge and celebrate your progress. Whether it's reaching a savings target, achieving a certain return on investment, or